This week, Valeant Pharmaceutical cut its outlook yet again, and it was not pretty.
Valeant's now trading at about $24 a share. Last summer, this stock was over $260, so it's no surprise that Valeant has now been the top target for Jim Chanos. He's a world-class short seller, and he sat down with Gary and I at the SALT conference in Las Vegas, where he told us why he decided to start shorting this stock.
We've been short for a long time, and I just never understood the model, and I still don't understand the model of this whole specialty pharma where you buy drugs, one-offs or small drug companies, and then hike the prices eightfold or tenfold. And I keep coming back to, well, why didn't the company that owned these drugs originally do that? Well, the problem was the reimbursement system, and that's what's broken at this point. The payers have woken up. The problem Valeant has is that it has $38 billion of net debt and long-term liabilities ahead of the common. So even today, the stock has got a total enterprise value of somewhere in the mid-$40 billion area, and it has a cash flow that's dropping. All that debt's ahead of you. And a little bit like the idea I gave today at the conference, Cheniere, we just keep focusing on ideas where the business is deteriorating and the debt is monstrous. And we think people are shying away from those stories.
Jim, last year when you joined us, we talked about sort of the art of short selling and how you have to really focus on the fundamentals as you do and stay away from the noise.
Right.
Two stocks that were darlings, one continues to be a darling in the street, Tesla and SolarCity.
Yep.
Both of which are short.
Both of which are short.
Yep.
SolarCity has had, I guess, a disastrous a situation of recent.
Yep.
And Tesla continues to be a big story stock. But these are stocks that the public has gotten involved with. So update us on those positions. And how does one stay fundamentally short when there's so much hype behind the stock?
Well, both of them we are still short, and so they're a little bit different, but I think they were linked, of course, by one man, Elon Musk. The SolarCity story is quite problematic because I think they're facing real financial cliff this year, because they're burning just a ton of cash, and their financing sources, one by one, are either getting much more expensive or drying up. And I think the problem of the rooftop solar model is under real question right now. It's not that economic, and it's not economic to SolarCity. So they're in the real conundrum, Gary, of losing money in effect on every solar panel put up and making up on volume. That's no way to run a business. They have just a ridiculous amount of money tied up in the business, and it's earning a very small return, and it's levered.
And Tesla, obviously...
Tesla's a different story. Tesla is selling a dream of 2025, that we're all going to be driving around in autonomous cars, watching Netflix, and checking our Facebook, and they'll be in Tesla cars, and Tesla will get a piece of that action. And if you talk to the real rabid bulls on Tesla, it's not about this year or next year, it's about some vision. The problem is they have to get to that vision. And that means they have to be a car company, and they've got to produce a lot of cars, and they're going to produce them at a loss.
But as a short seller, they had that record product launch, and they had the 22 million units sold. What's your reaction?
Well, they had the 500. They had deposits. They've taken deposits, and yeah, those are refundable deposits, and you're an unsecured creditor of Tesla. And they use those deposits to pay off a loan. I mean, a lot of people don't know that. It came out in the 10Q. It's just another way to finance the business, and he's burning a lot of cash at Tesla too. So both these companies are burning hundreds of millions of dollars every quarter, and constantly need to come up with new ways to finance themselves.
Okay, so let's talk about another one of your brilliant picks, Sotheby. You were with us a year ago. The stock's down 30% since you mentioned it on our show.
Yeah.
What's going on there? What do you think happens?
Well, we just had the spring sales for Christie's, so it's timely. Talking about Sotheby's in May is always timely, and the sales were down, anywhere from 50 to 70%. So the market is doing exactly what we thought it would do. It's dropping, and it's dropping because one by one we're losing the buyers.
You think it's because Gary Kaminsky stopped buying art? Is that one
I think that's has a lot to do with it.
I know that could have been a big
hedge fund guys were one of the last props to the market.
The problem was I never bought a piece of art.
But we lost the Middle East buyers, we lost the Russian buyers, we lost the South American buyers. We still have the Chinese buyers and a couple of hedge funds, and that's it.
What's the main noise in the system, the main smoke that you look at as a short seller that says, okay, something's wrong with the engine of this company?
You mean like the balance sheet, the cash flow statement?
The one thing I'll tell your viewers, that if they're not financial analysts, the one thing that I would tell your viewers to be very wary of is a company that shows two things. Lots of management stock sales from different people, but more importantly, management departures. If you are seeing a company where 10 or 15 or 20 people are leaving in the space of a year or two, look out. 2 companies in the last 12 months fit that bill. Valeant, Tesla.
By the way, and you don't need to be a financial accountant to have
Should
that
be like
as
some funeral music when he's talking.
All right, I want to talk about,
let's talk about funeral dirge.
You know, Jim, you look at these, you identify and look at these specific companies, and you're great at it. And I know that you build the portfolio by hedging out, by owning calls in the S&P,
We're
by
long,
being
yeah,
sort
we're
of
long the
market
market.
control.
We're long the market and short our stocks.
But I got to tell you, one of the themes at this year's event, even by those that are sort of perma bulls, being always bullish,
right,
is people are really concerned about the overall market.
Yeah.
They're concerned about the election. They're concerned
yeah.
about the multiple. You have any thoughts where the market is right now?
Yeah, again, I do, like anybody else, but they're not worth much.
Are you surprised, though, that so many of the perma bulls here are cautious right now?
Yet they seem to be fully invested. I mean, we were at a breakfast yesterday that you hosted, and one of the participants pointed out, well, the market's it's only at 16 times earnings. And I thought to myself, well, wait a minute. 16 times earnings is $130 some on the S&P. Trailing pro forma earnings are 106, and the actual reported earnings are $85. This guy is saying it's at 130. So one of the big disconnects is everybody seems to use their own valuation metrics to justify where we are. The market is quite expensive.
Also, if there's the specter of recession, which a lot of our guests are saying there's greater than a 50% chance of a recession, that will affect valuation numbers and impact earnings. So
earnings have been dropping, even ex-energy.
Right.
Earnings have been dropping, and so if we've hit peak profit margins for the cycle, it makes it tougher.
Jim, before we go, we have to ask you, situation in China.
Where?
China, as expected, any better, or is it worse since we last saw you?
It's always worse, and it's worse than I even think it is.
So it's getting even worse.
I mean, it's the People's Republic of Madoff, as my friend Jim Grant calls it.
Okay. All right. Well, we're gonna leave it right there on the People's Republic of Madoff. Jim Chanos,
Good to see you guys. Thanks very much for having me.
Yep, great to see you, Jim.
That was our friend and legendary investor Jim Chanos. Great insight and information as always.
And next week, our guest is former Pulte Homes CEO James Grossfeld, currently an independent director at BlackRock. We'll see you then.